This is Jennifer Schack, Associate Financial Planner at Severson Strege, and this is today's Finance Moment. Determining which investment vehicles to use to save for short and long-term purchases and retirement goals can be confusing. Today's Finance Moment will focus on 4 types of accounts: non-qualified accounts, traditional IRAs, Roth IRAs, and employer-sponsored 401k plans. Several factors impact which kind of account you may choose, including your income level, account contribution limits, and tax implications or benefits. As a disclaimer, I am not a CPA. Please consult with a tax professional before acting on this information. Non-qualified accounts include checking and savings accounts, as well as investment accounts. Non-qualified accounts are funded with after-tax dollars and are helpful savings vehicles for short and long-term goals. These accounts have no contribution limits or income restrictions. Additionally, distributions from these accounts do not have penalties and are liquid. For retirement savings, traditional IRAs, Roth IRAs, and employer-sponsored 401k plans offer tax benefits for funds intended for long-term investing and growth. Traditional IRAs and Roth IRAs have a combined annual contribution limit. In 2023, the contribution limit is $6,500 and $7,500 for those ages 50 and older. A benefit to these accounts is that funds grow tax-deferred. These accounts are different, however, in several ways. Traditional IRAs are funded with pre-tax dollars and are deductible if you are not currently enrolled in an employer-sponsored plan. If you are enrolled in an employer-sponsored plan, such as a 401k, the deductibility of these contributions may be reduced or eliminated. If you withdraw these funds prior to age 59 and a half, the distributions are both taxed as ordinary income and often incur a 10% penalty. So prior to investing in this type of account, you want to ensure that these funds will not need to be accessed prior to age 59 and a half. These funds then grow tax-deferred until distribution in retirement, at which point the distributions are taxed as ordinary income. Unlike traditional IRAs, Roth IRAs are funded with after-tax dollars. These contributions are not deductible. Additionally, individuals whose income is above a certain modified adjusted gross income threshold are not eligible to contribute to a Roth IRA. Like traditional IRAs, these accounts grow tax-deferred, but unlike IRAs, distributions from Roth IRAs are tax-free in retirement after age 59 and a half. Moreover, distribution of principal can be made without penalty at any time, and earnings can be distributed without penalty if the account has been opened and funded for 5 years. Another difference is traditional IRAs are subject to required minimum distributions beginning at a certain age, currently beginning between ages 73 and 75, depending on your date of birth. In contrast, Roth IRAs are not subject to required minimum distributions. Additionally, the beneficiaries of Roth IRAs also receive a great benefit. Although beneficiaries are subject to required minimum distributions, they continue to receive tax-free distributions. Another retirement account option is an employer-sponsored 401k plan. These plans can be offered by your employer and are unique to each employer. You will want to review your specific employer-sponsored plan for details. Like traditional and Roth IRAs, these accounts have contribution limits. However, they are higher. In 2023, the limit is $22,500 and $30,000 for those ages 50 and older. Common features of 401k plans include pre-tax contributions that are deductible and after-tax Roth contributions that behave similarly to a Roth IRA. Like traditional IRAs, you may be penalized for early distribution. Once retired, distributions of the traditional 401k account will be taxed as ordinary income, and distributions of the Roth portion will be tax-free. In many cases, employers will offer a matching benefit, where they will wholly or partially match your personal employee contribution up to a certain percentage of your salary. This is a great benefit. However, it is important to note that funds contributed by your employer may have a vesting timeline, which means should you decide to end employment, you may not be the owner of any unvested employer contributions. Once you have maximized the contributions to these retirement accounts, additional surplus cash flow could be invested in non-qualified investment accounts allocated for a longer time horizon. As mentioned, these accounts have neither income restrictions nor contribution limits. If you would like to learn more about these accounts, please view the blog article on our website, onlyworkforyou.com, titled Test Driving Investment Vehicles, Non-Qualified Accounts, Traditional IRAs, Roth IRAs, and Employer-Sponsored 401k Plans. Each financial situation is unique, with multiple variables and assumptions. If you would like to discuss your particular financial situation and the investment vehicles that may be most beneficial to you, please contact us at 515-225-6000 to schedule a free, no-obligation, complimentary consultation.